You ever been on vacation, you look at the exchange rate and just wonder, why? Why is one of your dollars suddenly worth less than €1? But then it's worth a mind-boggling 25,000 of something else in Vietnam. It feels completely random, right? Well, it's not. And today we're going to figure out exactly how it works. Here's how we're going to break it all down. First, we'll lay out the puzzle itself. Then, we'll look for clues inside a country's economy. After that, we'll see how the rest of the world's perception changes things. And finally, we'll tackle some of the big what-if questions that pop up. All right, let's dive right into the central mystery. Why isn't money just, well, equal? Why can't one of my dollars just be one of your dongs? It would make traveling a whole lot easier, that's for sure. So to make this super clear, let's invent a guy named Bob. Bob's from the US, he's got a wallet full of US dollars, and at home, a dollar is a dollar. But the second he hops on a plane, the rules of the game change completely. And this is where it gets kind of wild. Bob lands in Germany, and his dollar is actually worth a little less, only about 90 euro cents. But then he flies over to Vietnam, and that exact same $1 bill is suddenly worth 25,000 dong. How can the same piece of paper have such drastically different values? What is going on? To figure this out, we actually have to rewind the clock a bit. See, for a long time, most of the world was on what's called the gold standard. It was simple. A dollar was worth a specific amount of gold sitting in a vault. You couldn't just print more money without getting more gold. But that system started to crack by the 1970s. It was just too restrictive for modern economies. So we switched to something totally different. We entered the age of fiat money. And that's a fancy way of saying that the money in your pocket isn't backed by anything physical. Not gold, not silver, nothing. Its value comes purely from the fact that we and the governments that issue it all collectively agree that it has value. It's a system built entirely on trust. So, if our money's value is just based on a shared belief, how on earth do we put a price on it? Well, it all boils down to the oldest rule in the economics playbook, supply and demand. It's that simple. The more people want a currency, that's high demand, and the less of it there is to go around, that's low supply, the more valuable it becomes. Every single thing we're about to talk about just plugs into that one core idea. So let's start putting the pieces of that supply and demand puzzle together. We'll start by looking inside a country's borders, at the health of its own economic engine. First up, a big one you've definitely heard a lot about: inflation. In the simplest terms, inflation just means your money is losing its buying power. The dollar you have today will buy you less stuff tomorrow. And if you want a really extreme example of this, just look at Zimbabwe. Believe it or not, back in the 80s, the Zimbabwean dollar were worth more than the US dollar. But after years of economic chaos and the government just printing mountains of cash, hyperinflation took over. By the 2000s, it took 600,000 of their dollars to get just one US dollar. Nobody wanted a currency that was becoming worthless by the hour, so demand completely vanished. Okay, the second major factor you'll find inside a country's economy is another term you hear on the news all the time: interest rates. You can just think of them as the cost of borrowing money. And they set off this really powerful chain reaction. Think of it like this. When a country raises its interest rates, it means you get a better return for saving or investing your money there. Foreign investors all over the world see this and think, hey, I want a piece of that action. But to invest, they first have to buy that country's currency. That rush to buy drives up demand, and poof, the value of the currency goes up. All right, so we've looked inside the engine, but a currency's value isn't just about what's happening at home. So now let's zoom out and see how the rest of the world's perception changes the game. So imagine you're an investor with a lot of money. Where are you going to put it? You're looking for a safe bet, right? You want a country with a stable economy, a government that isn't about to collapse, and rules that aren't going to change on a whim. Countries that project that kind of stability act like magnets for foreign money, and more investment means, you guessed it, more demand for their currency. Now this right here is one of the most powerful real-world examples of that global demand. For decades, there's been an agreement that oil, one of the world's most vital commodities, is priced and sold almost exclusively in US dollars. Think about that. Pretty much every country on Earth needs oil, which means pretty much every country on Earth needs a constant supply of US dollars to buy it. That creates this huge, built-in, non-stop demand for the dollar, which is a huge reason it stays so strong. Okay, so now that we've got the key pieces, supply, demand, inflation, interest rates, stability, let's use them to answer some of the really fun what-if questions that come out of all this. So what if you're a smaller country and you just don't want to deal with all this up and down volatility? Well, you can do something called pegging. Take Brunei.
It's a small country, but it's rich in oil. It literally pegs its currency at 1-to-1 with the Singapore dollar. By tying its fate to a much bigger, more stable economy, it gets instant credibility and stability. The catch? It completely gives up control. If Singapore has a problem, well, now Brunei has that exact same problem.
And that leads to a really logical next question, doesn't it? If linking up creates stability, why not just go all the way? Why don't we just create one single world dollar and get rid of all the exchange rate headaches for good? Well, we actually have a real-world experiment for this, the euro, and it shows us the biggest danger. It's super convenient for tourists, but it means that individual countries lose control over their own money. The huge risk is right there on the screen. When Greece had a massive financial crisis a while back, the damage didn't stop at its borders. It spread like a virus to other healthier economies like Germany and France because they were all locked into the same currency. One country's crisis becomes everybody's crisis. Okay, one final assumption I want to challenge. We're always taught to think that a strong currency is good and a weak one is bad. It sounds right, doesn't it? But is it always true? Turns out it really depends on what your country's economic strategy is. If you're a country that imports a lot of stuff, like Singapore, which has to import a lot of its food and energy, then a strong currency is amazing. It means your money goes further on the world stage. Every imported car, phone, and banana is cheaper for your citizens. But what if your whole game is selling things to the rest of the world? For a huge exporter like China, a weaker currency can actually be a huge advantage. Why? Because it makes all the goods they produce cheaper and more tempting for people in other countries to buy. It's a powerful way to boost sales and keep all those factories humming. It's all strategic choice. So, as we bring this all home, you can see that a currency's value is never about just one thing. It's this constantly shifting cocktail of factors: inflation and interest rates at home, how much foreigners want to invest, how much a country sells versus how much it buys, and that all-important vibe of stability. They're all constantly pushing and pulling on those two basic forces, supply and demand. And that leaves us with one last, kind of heavy thought. If this entire complex global financial system, all of our money, is ultimately built not on gold, but on a shared story, a collective belief, what happens when people stop believing in the story? It's a question that really gets to the heart of what keeps our modern world ticking.